really excited to be here today and was really thrilled as we're discussing outside and chatting among some of the other people in the room that we have such a diverse array of experience here, coming from folks from academia, from wildfire modeling in that sector, to private sector experience within insurance companies and within CAT modeling companies, all of the sorts of things that are really necessary to bridge this gap that we have, this sometimes large gap between the scientific research and experience and capacity that we're developing in the public sector with the private sector depth of experience and how to actually apply that knowledge in this really critical context of insurability in California. I just want to highlight, this title for this today is really a critical one, because the insurability of California homes and communities in the face of rising climate risks, inflation, changes in development patterns, data is really critical to that. We need to, take action to protect our communities, to ensure their future insurability, to make sure that they have insurability in the future. We also need to understand and have data and research and understanding of what impact that kind of action has on the community so that we can value it. And then we need to be able to communicate that really effectively to stakeholders so that they are continuously motivated to take action and continue to work towards insurability of California homes and communities. So I'm Kara Voss. As mentioned, I'm the model advisor at the California Department of Insurance, which is the insurance regulator for all of the companies operating in the state. And I sit within our climate and sustainability branch. I, as mentioned, started out in the research community as a climate scientist down at Scripps Institution of Oceanography, focused on extreme weather research, before kind of transitioning into policy at the Department of Insurance in various roles, thinking about how climate change is expected to affect our insurance market, and then how what effects insurance companies' actions and investments have on climate change as well. But about a year ago, the department overhauled many of their regulations related to homeowners insurance in the state, specifically as it relates to wildfire rates, and created a process for allowing for models to be used for those rates with a rigorous review process. And so I stepped in as model advisor about a year ago to fill that role of developing our process for reviewing models, which I'll speak to a little bit more in my presentation. But this is part of a larger effort of the department in kind of building expertise and capacity around modeling and wildfire, as well as flood and other climate risk and disaster risk contexts. Within our climate sustainability branch, where I sit, amongst other scientists in the department and people with diverse expertise, we're also continuing to hire and build our team and our capacity around this. We're also building capacity in our rate regulation branch, which is the part of the department that reviews rate filings by insurance companies. That's how insurance companies change their rates over time. We have people coming in who have expertise in catastrophe modeling in other areas. We have a financial surveillance branch. They're responsible for making sure that insurance companies remain solvent and are able to stick around and pay the claims and fulfill the promises they've made to policyholders in the long term. And they have experience understanding wildfire impacts on solvency risks. But we're also relying, in addition to that internal capacity building, on external expertise. We have a public model strategy group from Cal Poly Humboldt that's been providing recommendations for the commissioner on how to approach public wildfire modeling. We have advisors within our model review process, the PRID process. The National Association of Insurance Commissioners has a modeling center of excellence that they've been building and continuing to build expertise that serves not only the California Department of Insurance, but insurance offices across the United States from other states, as well as a wildfire CAT model working group that's helped us develop what kind of standards and information we need to make sure that we're probing and requesting of modeling companies to make sure that what they're doing aligns with the best available science and incorporates information about mitigation. That's just a short list of some of the expertise we're relying on, But I wanted to kind of highlight that for this group, especially within the UCs as well as other kind of public sector entities. We're really seeking out that kind of expertise. And so if you're looking to do research in this area and support our efforts on building capacity, feel welcome to reach out about that. And we're happy to have some discussions about it. You know, I know this is kind of a diverse group, so we've got people who are within the private sector from insurance companies or from cat modeling companies that this might be really basic information for. But, you know, there is this kind of sometimes a gap in understanding between what's happening in the public sector around wildfire modeling and purposes such as understanding the risks of how wildfire is changing over time, or even in forecasting of wildfires in real time, which is a really critical feature. The way insurance companies use wildfire models is a little bit different from that. And so I just kind of wanted to go back and review some of the really use cases that insurance companies have for wildfire modeling at a high level. So the first one use case that an insurance company might use a wildfire model for is for a catastrophe adjustment for a rate. So this is how much an insurance company needs to charge across all of their customers in the state in order to cover what they expect to have to pay out because of wildfire in an average policy year. And so they need an estimate of what's kind of my average losses for a year across my whole book of business. This they used to do until about a year ago. This was done with a 20-year average of historical wildfire losses for any given company. So a year ago, we allowed them to use models for the first time, and I'll get a bit into that. The second use case is segmentation. So this is how an insurance company needs to distribute that rate across different customers in different segments or groups based on their risk as well as other factors. The third is underwriting. So which properties are within my risk tolerance, which properties should I insure, which properties should I not insure. Reinsurance contracts. So reinsurance is insurance for insurance companies. And a wildfire model might be one of the factors that contributes to how much an insurance company has to pay for reinsurance, when it kicks in, like what triggers it, and other aspects of how those contracts are structured. And then the last one is solvency. So how much does the company need to hold on reserve because of major catastrophic events? How should they manage their risks to make sure that they're around in the long term to be able to pay claims and fulfill their promises to policyholders? So the sustainable insurance strategy, which is the changes that were made to the regulations last year, were allowed for companies that agree to expand insurance access into high-risk areas that are having difficulty accessing insurance. They can use what's called a wildfire catastrophe model to come up with their catastrophe adjustment, so that rate that gets charged across all their customers. And they can also include some amount of their reinsurance costs in their rate equation. One of the keys here, so this was a big change, and I'll get into why this was really important, an important improvement to the historical loss way of doing things. But one of the keys I also wanted to mention is that the companies have to use the same model for their component of their reinsurance costs as for their catastrophe adjustment, and this creates kind of a bit of a check and balance system to create the right incentives for a company to produce a really actuarially sound estimate of what they think their actual wildfire risk is. There's also another broad category of wildfire model that insurance companies use. I'm going to call it a risk model, but these are kind of heterogeneous in nature, so it's a little hard to kind of call them all one thing. But a catastrophe model, which is the kind of first category, has a pretty defined structure, which I'll get into. And it can go all the way from the hazard of representing a peril or a type of catastrophe to an insured loss, like dollar amounts. Risk models sometimes don't go all the way from the peril to the loss. They're more for representing how risk varies geographically or across structures broadly, and they have quite a bit more variation than cat models do in some ways in how they function or what they look like, but they're often used for segmentation and for underwriting purposes, as well as potentially for other purposes. And I just want to highlight the sustainable insurance strategy. The changes that happened last year were mostly to do with CAT models. However, the department also has rules within the last 5 years about segmentation models, specifically that there's a list of actions called the Safer from Wildfire actions that are really aligned with the IBHS standards, where if homeowners take certain actions to protect their home, to mitigate their home to wildfire, they can receive discounts for each of those actions that they do. And the models are set up to account for the impact of those actions. So what is a CAT model? Again, this could be basic for some of the, Karen Clark in the room, who's an expert in this, of course. But CAT models, CAT models generally are probabilistic models that represent hundreds of thousands of versions of what a year of catastrophe could look like, in this case, wildfire, using sometimes semi-physical processes, established scientific concepts, actuarial science, engineering, to come up with an insured loss estimate. So they usually have these 3 major components. The first is the event generation and hazard module. This is the part that represents the disasters, represents the catastrophes on the landscape, how they're distributed geographically and how probable they are. The second is the vulnerability module. This is the part that applies damage functions that represent if a structure is exposed to some intensity of the catastrophe, what is the resulting damage to that structure based on its construction, its occupancy, and what kind of mitigation features are in place. The third is the financial module, and this is the part that accounts for the value of the structure, how much damage, how much dollar value loss occurs due to that damage, and insurance policy terms. And then the user of the model, in this case the insurance company, but it could be other users as well, input what's called the exposures. So that's their book of business that they're interested in. So based on the locations that they put into the model for those properties that they're interested in, that'll affect how much of that hazard they're exposed to. Based on the construction materials they put in and how mitigated those structures are, that'll affect which damage functions are selected and therefore how much damage occurs. And then the policy terms that they put in will affect the ultimate insured loss amount that the model is estimating. And the model aggregates this all up to estimate that total insured loss for that book of business. So for wildfire, what this looks like is this event generation and hazard part of the model is igniting and spreading wildfires along the landscape and representing hundreds of thousands of versions of what a year could look like in terms of where there are fire footprints on the landscape and how intense the fire is. The vulnerability, and that's based on fuels, weather, ignitions, how fire is managed, how fire is suppressed. Then the vulnerability part is representing, okay, if a structure that is made of wood frame, but has all of that other IBHS standards for how it's constructed, would get a more mitigated damage function applied and therefore might experience less damage at a moderate flame length than a structure that's wood frame and has, very combustible materials and no defensible space might have a damage function that it receives more damage for the same level of flame length. And then that financial and insurance terms, this works kind of the same across different perils for the most part, but it's applying all those policy terms and values to come up with that insured loss amount. Some of the things that these models can do that previous system of historical losses could not. I think I probably don't need to describe this for this group in particular, but the models can account for changes in land use. We've developed into areas that are higher risk than we did 20 years ago. So changes in new developments on the landscape, changes in fuels. Fuels don't necessarily look the same everywhere as they did 20 years ago. Changes in climate. We have more fire weather days than we used to. Models can be adjusted to account for that impact and how climate change has already changed wildfires and fire weather. Changes in fuels and management, the way we manage fires, as well as economic changes. I report from Verisk indicated that replacement costs and rebuilding costs have increased over 60% since 2015. So if you're using historical losses directly, you're not accounting for those changes. So it's really key that these models can produce a more actuarially sound estimate of loss than what a historical loss estimate might come up with. And then extremely critical for us and how we view the insurability of California in the long term, models can account for mitigation. They can account for landscape level mitigation. So when they're igniting and spreading fires in that event generation and hazard part of the model, there's a fuels layer. And so if you do mitigation in an area, you can actually change the fuels on that layer to account for the fact that if a fire reaches there, there's not as much fuel, it might slow or stop. So in that way, it can affect the risk. You can account for that kind of large-scale mitigation. Property level mitigation, all of the actions that Steve Hawks will speak to shortly about the IBHS standards. Models can be equipped to handle those, to be able to select different damage functions or adjust damage functions to be able to account for how that affects the risk of an individual property. Community level mitigation, how does mitigate an entire community, which is the most effective approach, how can that impact the result of a model and the insured loss amount? And then also mitigation by other groups, including utilities who are changing ignition risk or changing fuels within the near power lines and taking those kinds of actions. Those kinds of things can be accounted for. And this field is continuing to grow. We're continuing to get a better understanding of what impact these have and being able to account for more of these actions. But if you were using historical losses, you're going to be left with the same number regardless of how much action you take. And we think that it's appropriate to be able to account for all of these really important actions that people are taking. Now, we've demonstrated that models can be really helpful, but we still need proper checks, right? We need to make sure that these models are not just taken off the street with not much expertise. We really want to make sure that they're serving policyholders by accounting for mitigation, by taking into account the latest and best science. And so I lead our model review process, which is called the PRID, the Pre-Application Required Information Determination Procedure. Anyone can participate in it. They can petition to participate in it. It is confidential in the process of getting there, and so anyone who can sign the NDA can participate in this model review and ask questions in that process. And it allows us to rigorously review every component of the model and run test cases and sensitivity and validation tests with the model. The key is that this is done in a process outside of the rate filing step, and that allows us to just, you can imagine if every time an insurance company had to come in using the same model, that we would need to dig into it each time. That's not a very efficient process, and so this model review PRID process takes the model outside of the rate filing process and says, okay, let's review the model before an insurer ever uses it to make sure that it's able to account for these things, it's methodologically sound, so that when it comes to a rate filing, the rate filing team can focus on how the model was used, what data was put into it, and what settings were selected by the user. We have a wildfire cat model checklist that we worked with 8 or 9 wildfire experts on, including some of the people we're talking on panels today, to help us ensure that the questions we're asking of the models and the standards we're holding them to are really aligned with the science and standard practice around wildfire modeling. And we have standards in our regulations that specifically say that these models need to use established concepts, data, equations, and best available science, and to account for the best available scientific information on risk mitigation at the property, community, and landscape scales. And this is really important because we needed to make sure that we had a framework that allows us to evolve and hold these companies to standards that align with the best available science, even as the science is evolving, which is a significant thing in the wildfire science world. We're continuing to get better at this, and we need the modelers to continue to get better at it as well so that they can best serve the policyholders in the end. In addition to those efforts around private sector modeling and incorporation into rate filing, we also, there's this public wildfire model strategy group came up with recommendations for the commissioner on how to approach public wildfire model to make tools that are available for local governments to understand risk, for other stakeholders to be able to test the impact of mitigation actions, understand what kind of damage can occur because of catastrophic wildfires and how likely they are, as well as potentially for smaller insurers to be able to have a tool that allows them to compete in the marketplace and get an actuarially sound estimate of risk, which is critically important. Judd will talk a little bit later today about how important that can be for the market and market dynamics. We don't know exactly how this kind of public model may be used, but we'll be developing a grant program for one or more universities throughout the states to develop it in a way that it can be used by a range of stakeholders and with a particular emphasis on mitigation and disaster resilience. And then I just wanted to close with one final point about where I think that the research community can really contribute to these efforts. There are a few areas where I think it's really critical for the research community to help us evolve the science around wildfire modeling and how it gets incorporated into insurance purposes. One is urban conflagration risk. This urban conflagration risk is really important for insurance companies. It's really important for how they understand risks to communities because those devastating urban conflagrations are where really large losses occur. But the science around it is still relatively new, even in the academic sector, right? We're still learning how to account for impacts of community mitigation, different construction features, and just kind of some basic elements of how wildfire spreads through built environments, through urban areas, and how buildings act as fuel. And so that's an area where I think we need to continue to evolve and make sure that the private sector is staying in line with the academic understanding of things and that they can work together to be able to understand this risk. Because in some ways, the insurance companies might understand this risk better than the academics in some certain areas, and then vice versa. So really being able to work together on those kinds of understandings is really critical. Impacts of property level and mitigation efficacy, we know that it has an impact. We know that it's really important. There's plenty of information to demonstrate that. But understanding the specific ranges around how important combinations of elements can be really important for an insured loss, and therefore how you account that into pricing and create the right incentive structures for action. Utility mitigation, there's been a lot of effort on that in recent years, but there's still kind of limited data sets around it, around what is being done and how effective it is. And the more data is out there on that, the better that the modeling companies can take it into account. Public data in general, like if the data is there to account for things and to do that, the modelers will pick it up. And so public data is critically important for that. A lot of models, even in the private sector, rely on a lot of federal data from the U.S. Forest Service or from NOAA. So we also need to think about the longevity of those data sets and making sure that we have available options in the long term, regardless of what kind of turmoil is happening. And then lastly, climate change. Again, we know that wildfire is impacted by climate change, but we still need to continue to evolve the methods in how it's accounted for and make sure that as we see the impacts of climate change play out in observations, that we're adjusting our methods to make sure they stay in line with that and are still accurately reflecting the impact that climate change is having on wildfire. With that, thank you so much, and I'll look forward to the panel.